One of the chief concerns in markets over recent months has been navigating stagflation risk. Slower growth, sticky inflation, and geopolitical conflicts that continue to generate volatility in energy markets. On top of that, we now have a Federal Reserve that's become unwilling to provide forward guidance when it comes to the interest rate outlook. Yet, many cyclical equity markets in the developed world now trade very near or at record highs. Germany's DAX has already got there, while the Russell 2000 in the United States and Australia's ASX 200 look like they may soon join it in record territory. But why? I think incoming economic data provides at least part of the answer. The first place I looked was Citi's Economic Surprise Index. Now, this isn't a measure of economic growth. It measures whether incoming economic data is beating or missing economists' forecasts. Data releases that have historically had the biggest impact on markets carry a larger weighting, while older surprises gradually fade over time. I average the surprise indices for the US, Euro area, and Japan, and the result honestly surprised me. The latest reading ranks stronger than roughly 92% of all observations over the past decade. That doesn't mean these economies are booming by any stretch. It simply means that the data has consistently come in stronger than economists expected. That helps explain why cyclical markets may have been so resilient. But then I added in China. Japan has been the standout recently, consistently beating economists' forecasts. The Euro area has also improved sharply, with economic data consistently surprising on the upside since the early stages of the Iran conflict. The US, while off its highs, has spent only a handful of trading days in negative territory over the past year. China, though, has gone the other way. Earlier this year, its economic data was generally topping expectations, but since the middle of May, it's consistently disappointed. That's the divergence. While major developed economies have outperformed, China has rolled over. The US, Euro area, and Japan account for around 45% of the entire global economy. That's already enough to matter. The next question is China at just under 20%. If data there starts surprising on the upside again, you'll have the world's largest developed economies and the world's second largest economy all outperforming in unison. Historically, that's been the sort of backdrop that's delivered the strongest global nominal growth stories and been very supportive for industrial commodities and cyclical assets more broadly. The question now, though, is whether China will ever be allowed to join the party. Best of luck with your trading. I'll catch you next time.